Welcome, everybody. I'm so glad you're here. Thank you for tuning in to listen to a profile of one of the offerings on Invest with Glow. I am here today with Ty Lee. Ty, how are you?
Great, Joseph. How are you?
So good to have you on. We've um, connected and touched base a little bit, and I've gotten to know a little bit about Common Ground, which is a fund, a real estate fund. So, could you tell us, Ty, a little bit about what the Common Ground Fund is and what the investment opportunity is?
Sure. Yeah. Thanks for having me, Joseph. Hello, everyone. Common Ground Capital, in its simplest form, is a fund that acquires, holds, and renovates single-family homes, initially in the Dallas-Fort Worth area. Our target returns are north of 20 IRR and a 2 equity multiple for our investors over about a 3-year hold. And there's a lot of people entering this space, but for us, we like to think about design and service as some of our differentiators.
That's so fantastic. And I was really impressed with what the design of the investor return is. So I'm going to hold that to the end. That's going to be kind of where we get to on this conversation. Let's start with you, Ty. You're the managing director of Common Ground, and it's kind of I look at your management team. You're kind of the point person of this. Tell me a little bit about your background and how did you get into managing a fund, specifically in real estate?
Sure. Uh, I am from Tennessee and went to the University of Tennessee. So a very sad football team for about 20 years. But I think we're trying to make up for it with other sports. I went to the architecture school there. And so for the first decade of my career, I was actually a practicing architect. And I did everything from $400 million clinics in Abu Dhabi to small boutique retail shops.
Wow.
And,
Well, I'm
over.
sure that clinic in Abu Dhabi is now being run by the Mayo Clinic, which is, a Minnesota-based company. Okay, keep
Oh,
going.
Minnesota plug. Fair enough.
Yeah, I just had to get that plug in. I do notice your background is Dallas, and it's looking pretty beautiful.
Oh, thank you. Yeah, we don't have any mountains like people on the West Coast, but we do have great business philosophies. So over time, my heart gradually went towards the business side of real estate. And so for the past 7 years, I've been on the principal side of commercial real estate development. So that means average 50 to $100 million mixed use developments, both at acquiring existing assets and developing ground up. And so think office buildings, multifamily, restaurants centered around green spaces. And when as a developer, when you think about what asset classes have runway for the foreseeable future, we start to really think about things from the view of anthropology and demographics. And so we start to think about, okay, millennials are the biggest population group in our country, right? Over half of the families in our country are the parents are millennials that have children. And so you think about the runway and the demand for single family housing for the foreseeable future. We felt really bullish about single family. And frankly, Joseph, there's not a lot of institutions in this space yet, like multifamily. And I think there's a lot of room to innovate. So that's kind of how we got here.
Yeah, I come out of a community economic development background myself, and um, building and renovating single family homes. And I've always felt that there was such a focus on the big multifamily, and that they really missed the incredible opportunity in the single family. And it was very disappointing to me when I did that community economic development that the only folks that seemed to focus on the single family were, for the lack of better terms, and I apologize, slumlords, right? That were really looking at really the low rent. And when that's not what you guys are doing at all. When I look at the target acquisition and the target rent that you guys are doing, you're right in that medium. You're hitting right in that medium. You tell me why. That's so interesting.
Great question, Joseph. So for us, at the very top of our priority list is we want to make sure that we return, provide a decent return to our investors. And so at the core of that thesis is school districts. We're very bullish about assets in great school districts. And when you
That's an
study the,
incredible, just as a side note, you've got some incredible school districts in the Dallas Fort Worth area.
oh,
You've
thank
got
you.
good,
Yeah.
good stuff to work with there.
Yeah, Capel, Plano, Frisco, Allen, McKinney. And so we look at these neighborhoods and the houses and then we also layer in a tenant profile that's also important to us, Joseph. So credit scores and things like that. And our past historical data has shown that a certain profile of renter will create less maintenance costs because they kind of take care of things themselves and they pay rent. And when you combine all these factors, it ends up being a specific price point. And we also have to be careful about balancing the market. So we don't want the rents for these homes that we buy to exceed what the renters will pay in the market. So all these things combined is how we got to that price. And we're still getting 6-7 yield on cost going in.
That's great. And you're also, I found fascinating was that because you were at this medium and targeting that medium, then and you were very selective in the properties you were buying, you weren't actually contributing to that evil word of a gentrification, right? You weren't actually coming in low, trying to jack it up, hold it until you can fill it with a tenant that didn't fit the profile of the surrounding area. And I found that really fascinating and kind of unique and special.
Thank you. You know, we are interested in helping build communities. We're not interested in, the typical merchant builder mindset, which is come in, do your thing, and leave as quick as possible. We're interested in helping create the fabric because you know what? Strengthening the fabric of a community strengthens the economy all around it.
That's so true, and that's spoken like a really good community based architect. I mean, when I first started reading the Common Ground material, all of which is available for any qualified investor at Invest.withGLO, um, I I was surprised at having a leader that came out of that architecture background and really kind of intrigued. And then you and I spoke earlier, and you said for you this is about the community and the green space and the schools, all the way over to interior into the interior design. So tell me a little bit about kind of that scope of what you're bringing, that unique difference that you're bringing as an architect to this fund.
Yeah, sure. So design is so important. Think about this as an example, and let's even go outside the world of real estate. Think about Apple as a
Yeah.
design company, right? So when you think about really appealing to the intangible parts of a person, that creates some really great brand strength.
Does.
So the analogous version to real estate is, think about what does a family today need? Do they need flexible space? Do they need one of those rooms to be able to function as an office or a bedroom? And do they want kitchens connected to their living
Or,
spaces?
frankly, as an online schoolhouse.
Exactly, unfortunately. And these all these things were happening before the pandemic. And we also can kind of see things that others can't. So for example, we bought a house that was right on a super busy street. And another investor had a house about four in, so a better spot. But you could tell they kind of spent money on the wrong places and they
Yeah.
were, the bad materials. We realized that there was a great opportunity to add a fence and create an incredible backyard for a young family. And so even though it was on a busy street, our home sold faster and for more. And we also thought about, the impression you get when you first walk up. So we think about what can we do on the front porch to really create a sense of arrival. And so I think it's all of the above, Joseph. It's important to people.
Yeah. I have looked at a lot of real estate funds and a lot of residential real estate funds. And
Oh,
um,
Joseph, sorry. Can I add one more thing? I
yeah,
apologize.
please do. Please do.
And when all these things work out from a design perspective, not only is it more enjoyable, but frankly, it typically equates to better returns, higher rents. Sorry.
Yes.
Yeah.
No, absolutely true. And that's very good for the investor because there's a couple things, right? Investors want that really good return. They also want risk mitigation. They do not want, I mean, it just destroys the return to have something bad happen at a property,
That's
right?
right.
So, so much of that building community is also about weaving that family into their surrounding area and really making it work. So,
That's right.
um, you know, one of the things I noticed on your offering is that you don't have a real estate management company on your team or as part of who you are. You're not also running your own real estate management. And I think that a lot of folks that do these residential funds try to differentiate themselves with their own management company. You guys saw that very differently. Tell us what you were thinking and why you've gone the route that you have.
Great observation. So it is hypercritical to us that the service that we provide to our tenants is top class, because there's nothing that helps with renewals better than that service, right? And so for us, we're not going to create that unless we think we can do it better. And so at whatever juncture that we feel that's the case, we're going to take it in house. But for now, this is not finalized yet, but we're close to hiring Mind Property Management for
Which is
our platform.
one of the big boys down in Dallas.
Yeah, and we looked at their platform, Joseph, and they have apps and technologies. They have a dedicated team. We get a portfolio manager, a resident manager, and their response times are incredible and their renewal rates are fantastic, which is telling me that their tenants are happy and they have these processes dialed in.
And why
So
would you try to rebuild that? Then you become a rental property company as opposed to a
yeah,
real estate fund.
and they're competitive because they know that when they do a good job, they don't have to charge high fees. It's more volume for them.
Right. So, you also did that on construction, right? You're also not a fund which is just the front for a construction company, right? So tell me what you're doing on the construction side of things.
It's the same mindset. We want to team up with the people that are good at what they do. So we want to team up with the people that have leverage over all the plumbers, over all the painters, the guys that can control the costs and the time associated with all those subs, because
Right.
we want to monitor and manage the fund. We don't want to be a construction company or a property management company. And so we strategically partner up with guys that are really good in that space.
I think that is so fantastic. And I really appreciate that. And I just want to reiterate how powerful that is, that for an investor, you're investing in a fund that's being run by people who know the industry, but aren't trying to be all the different parts of the industry at the same time. And I think that's really key. The
Thank you.
other thing I really liked was your aggressive um, returns that you're structured right into the deal for the investors. And I was wondering if you could kind of highlight that. It's 100% return until, and then 85% return until. Could you kind of go through that structure?
Yeah, for sure. We have a waterfall structure, and like any investor, and I'm an investor myself. I want to make sure that I'm the priority, right? And so the way our waterfall structure works is that the very first priority is that everyone gets their money back. That's the first priority. The second priority is an 8% preferred return, right? For you trusting this thesis, we want to reward that. And then it flips and it becomes a 10% to the manager after the 8% preferred. And then it becomes, I believe it is a 25% over 15 IRR to the investor, and then a 35 over 25. And we underwrite conservatively, Joseph. And so we actually think there's quite a bit of room to outperform. And the punchline being, for every dollar an investor invests with us, we are projecting that they will get $1.89 back in about 3 years.
So I just want to kind of repeat that's 100% return of capital to the investors. Then 100% of return is going to investors until 8% IRR. And that's when then the managers kick in on 10 over 90 to 15, 20 over 80 to 25, and 30 over 65 moving forward. That only makes sense if the managers are also investors.
Yeah, that's right. So interests are aligned, right? I come from a commercial institutional background. And so we always have to do things where interests are aligned. And that's certainly the case here.
And that also implies to me that that the management team are sitting on the cap table as investors as well.
100%.
Yep.
Absolutely. Yeah.
So you guys are not just managing other people's money, you're managing your own.
Yeah. Yeah. We're highly motivated to be successful. That's right. Yeah.
You've got kids at home. I get it.
I do. Yeah. They're expensive kids. Yeah.
Yeah. So fantastic. So let's go back. So this is a fund where your money is coming in with other people's money,
Correct.
with the management team's money. The management team is managing that fund.
Correct.
They're going to call on capital on a regular basis
Correct.
as they need it when you find a home that fits your thesis for you to buy. And some of
Yeah.
the homes you're buying and you upgrade them and then rent them out, and others you upgrade them and sell them.
Yeah. Yeah. That's right. I would just add a couple of things to that, which is uh, we want to hold them for at least a year for a couple of reasons. One, that provides long-term capital gains pass-throughs to our investors, as long as Biden doesn't screw that up. And then two, typically, if you hold a house for a couple of years, the equity multiple is higher. So the guys out there and the gals out there to understand the relationship between IRR and equity multiple, we look at both. But we like equity multiple a lot because to double our money in a certain time frame means more to me than to have a super high IRR in a few months.
Right.
Yeah.
So fantastic. So if you're watching this and you're an investor, all of the information about this deal is available on invest.withglo.com. All you have to do is register in, verify yourself as an accredited investor. You can view all of that basic information. You can sign an NDA and get backroom access to additional information. But what's more is that you can connect directly with Ty and his team and talk with them. I know on an investment like this that your confidence to write that check and to start that processing is really your confidence in the team. And the reason that we're excited to feature this on Invest with Glow is that Ty and his team, Jeff, are members of the Global Leaders Organization, and they have connected with us. That we're getting to know them, they're getting to know our members, and we're proud to have their offering being featured on the Invest with Glow platform. All
Joseph,
right.
thank you so much. Great.
So